Ladies and gentlemen, we have some breaking news to get you started on the first day of trading coming tomorrow morning. In fact, being reported about 20 minutes ago, Iran has canceled all flights in or out of the country from tonight at 9 p.m. through Monday morning. This likely means Israel's retaliation against Iran is probably going to occur before market open tomorrow morning, which this is the bottom line. If Israel does not attack the oil production capabilities of Iran, this will likely just be a buying opportunity. Now, if you see oil spike in any kind of material way, if there is an actual reduction to the oil supply hitting the markets, then we are in a much bigger problem. There is speculation that oil could rally to $100 a barrel on the low side and over $200 a barrel on the high side, depending on the magnitude and targeting of the oil market in Iran. This would have dire global consequences. I don't think this is going to happen, but I mean, just imagine oil were to spike in that kind of fashion. You are going into a recession. Like, there is no doubt about it. Oil spikes tend to lead to recessions when economies are weak. That's because a spike in oil is like a huge national tax that just comes out of nowhere. This is a tax on every business in America. This is a tax on every citizen in America, because everyone is affected by oil. Now, young Biden has said that Israel should restrain, I shall say, from attacking the oil production capabilities in Iran. So we will see if they listen to Biden in that, well, it sounded kind of like a warning. Now, this could be exactly what the markets were looking for the second week of October to sell off. This is the second week of October in the last 5 election years. In 2004, the S&P was down 1% this week. In 2008, the S&P was down 19.8% in this week. In 2012, you were down 2.22% this week. In 2016, you were down almost 1% this week. And in 2020, you were down almost 4% for this week. So in fact, over the last 5 election years, this week has been negative. Now, if you take an average return of these 5 weeks, you end up at negative 5.5%. Now, that's heavily skewed by 2008. But if you exclude 2008 and just look at 2004, 2012, 2016, and 2020, you are still at an average return of this week of negative 2%, almost exactly. And what a lot of people are saying is, hey, we've been 0 for 5 of this week for 5 election cycles. Perhaps this could be the week where things are actually green. And honestly, that makes some sense. Albeit, when you look at Friday's candle, you had a big retracement from the lows on Friday when you hit 568 or so on the S&P, on the SPY ETF that is, and closed at almost 573. That was a big retracement, and this tends to lead to higher prices when you get these kind of candles. And as I explained in prior videos, this candle specifically is so important. I mean, this down wick. That means sellers took over, got exhausted, and buyers stepped in and sent the markets near the high of the day to close out the trading day. That happened again back here on September 11th. We rallied after that. The last time before that a candle like this happened was on May 31st of 2024. You had a very aggressive rally. Almost every single time you get one of these candles, you end up rallying afterwards, okay? Before that was on May 2nd, you rallied. And if you don't believe me, just look at what Google says. Google says, conversely, a lengthy lower wick indicates sellers initially dominated, with buyers making a strong comeback. Such patterns are not merely reflections of high volatility. They signal potential market reversals or continuations, depending on their context and the prevailing trend. And just in simpler terms, what does a low wick mean? That sellers managed to control the session but couldn't hold on when the buyers pushed price back up. So anyone that likes to look at the markets from a technical perspective should be very excited with what we've seen on Friday. Now, with that said, we also have a big week of economic data as well as the start of earnings season. It's kind of started already. We've gotten FedEx, Darden, Nike, Levi's. We've gotten some companies, Costco, that's reported earnings, but the bulk of earnings season starts this week, and we'll look at that in just a moment. But for Monday's trading day, you do have some Fed speakers, Fed Bowman and Fed Kashkari, as well as Fed Bostic and Fed Musaliam. I think it's safe to say markets are going to be reacting to this whole Iran-Israel situation coming Monday, assuming, I imagine, Israel told Iran they're about to be attacked within the next couple of hours to get ready. That's kind of what you've seen recently. These countries kind of give each other a heads up on what's coming. So I think there's going to be some damage control done. I think Israel's main target right now is to take out Hezbollah and then focus on Iran. I don't think Israel is going to try to take on Iran and Hezbollah at the same time. That doesn't make a whole lot of sense to me. So I think it's going to be a whole lot of damage control being done. And ultimately, if the oil production, again, capabilities are not targeted in Iran, the markets will probably buy the attack, if you want my honest opinion. Because at that point, maybe escalation is over with. But we'll see. So that's it for Monday. For Tuesday, you're going to get Fed Collins, Fed Bostic, imports, exports for the month of August. Now, that will be interesting because it will affect your GDP update from the Atlanta Fed, in which we're expecting the next update on Tuesday per this import and export data. So that'll definitely move things around a little bit. Fed Jefferson speaks at 7:30 in the afternoon as well. On Wednesday, you get Fed Logan, Fed Barkin, and Fed Goldsby that speak in the morning. Fed Logan, Fed Williams, Fed Barkin, Fed Jefferson speak around noon or lunchtime. You have the FOMC minutes Wednesday that come out at 2 p.m. This doesn't tend to move things too much because it's backwards looking. I mean, it's basically a transcript of the last Fed meeting, why Fed officials did what they did, and it just doesn't tend to move the markets too much. So even though that's highlighted in red as a big catalyst of potential volatility, I don't think it's going to be, because it never is. That's just what I've experienced, or at least over the past couple of years. Now, Thursday, you're going to get CPI. Core month over month is expected at 0.2%. Last month was 0.3%, so that would be a good number. Year over year is expected to fall to 3.1% from 3.2% before. Headline inflation is expected to fall to 0.1% month over month from 0.2% month over month last month. And inflation headline year over year is expected to fall to 2.3% from 2.5% last month. Now, I honestly don't think inflation is really a catalyst anymore as long as it does not go up. As long as we continue to see these good month over month numbers coming in, you're going to eventually get down to 2%. We all know this, or potentially undershoot 2% inflation like Fed Waller was suggesting. But it's going to take some time, and I don't think the markets are really going to care unless we start to see inflation rise. And then I don't think the markets are really going to care about inflation rising until we string together a couple of inflation reports in a row that show inflation is rising. That would potentially derail the Fed's rate cutting cycle that they are now in. But again, this inflation report this week is not going to move the markets all too much. Like, it's really not going to do much of anything. We're going to wake up and be in the same situation as we were the day before. Now, initial jobless claims, I think, is going to be a bigger catalyst that markets respond to. Last week, initial jobless claims came in about 7,000 higher than expected. We were actually expecting this number could fall to 223,000 from 225,000 last week. If you start to see a rise here, that's what Wall Street is really going to be concerned with. If this rises to something like 230 or 235,000, then I would expect a little bit more fear to grow in markets. But we'll see. Obviously, that's a pretty volatile data point that comes out every week. Now, on Friday, we are going to get PPI month over month, expecting 0.1%. I actually think PPI is a little bit bigger of a catalyst right now, believe that or not, because PPI is producer price index. It's like company costs, okay? CPI is consumer price index. It's consumer cost, okay? So if PPI starts to go up, then that could mean margins are compressed if CPI does not go up as well. Now, we are expecting PPI is also going to fall from 0.2% last month down to 0.1%. But imagine if CPI comes in low and PPI comes in high. Then you could start to make the argument, are company margins starting to be affected maybe by oil or energy or something else. So we'll see. I think that'll be something to look out for. Michigan consumer sentiment is going to come out for October on Friday at 10 o'clock in the morning, expecting an unchanged headline reading of 70.1. 5-year inflation expectations expected to stay at 3.1%. Consumer expectations expected to actually rise from 74.4 to 74.5. Current conditions are expected to rise as well from 63.3 to 63.8, and 1 year ahead inflation expectations are expected to fall from 2.7% down to 2.6%. As far as earnings to go in this week, on Tuesday you have PepsiCo. On Wednesday you have Helen of Troy, as you have Applied Blockchain, couple other smaller names, but really none that are important. Let's be honest. Thursday, you have Tilray, Delta, Domino's in pre-market. Here, Test Solutions, one of your AI adjacent companies that reports. Friday is going to really be the big day of this week, though, with JP Morgan, Wells Fargo, BlackRock, BNY, and Bank 7 that will start their reporting, really start off Q3 earnings season by and large. Now, these banks will be important because they will tell us a little bit more about the consumer. If the consumer's still spending money, what bank account balances look like, what savings rates look like. We will get a lot more data. And the banks, as well as every other company, they're obligated to be honest with you. They're obligated to tell you the truth, or they will go to prison if they don't. And I think that's why this earnings season is going to be so important, because the government data we're getting is just not very good. The Fed has zero obligation to be honest with you. In fact, it makes sense why the Fed is lying to us right now. The last thing the Fed wants to do is spook the markets, cause layoffs, and push us into a recession. You really want to see what this earnings season brings for markets. And I think that's why really the election is not a big deal right now, because of the uncertainty we have around the economy and around just the S&P and earnings growth, like company earnings. How are they going to be? We really don't have a great understanding of that. The companies that we have seen so far in this earnings season report have not reported great things at all. So I think this is actually going to be a bigger catalyst than everything else, and that is Q3 earnings. Now, it is being reported that China will hold a press conference on Tuesday, October 8th at 10 a.m., 2 a.m. GMT. Senior officials from the National Development and Reform Commission, NDRC, will provide an update on the comprehensive implementation of a package of incremental policies to robustly promote upward economic momentum, optimize structural development, and sustain a positive growth trajectory. The officials will also answer questions from the media during the event, and it wouldn't surprise me if we see another round of stimulative measures get announced. Now, just a brief look at some of your sentiment barometers for the SPY. This is the S&P 500 ETF. Sentiment is currently bullish at 72. Yesterday, it was bearish at 30. So as people are starting to prepare for the first trading day back of this upcoming week, people are actually getting more bullish. Like, the bears are not coming out. It's bullish as far as sentiment. Message volume is high at 58, and the participation ratio is normal at 53. On last account, the percent of stocks trading above their 50-day moving average is at 59.62%. On Friday, you had 6% of stocks break above their 50-day moving average. So out of thousands of stocks, 6% of them broke above their 50-day moving average. That's a pretty good number. Now, lately, we've been bobbing between 50 and 65% of stocks trading above their 50-day moving average. There is room for this to go higher. Usually, when you're getting to the end of a bear market rally or getting to the end of a rally in general before a correction, you can get as high as 85+% of stocks trading above their 50-day moving average. Now, that's pretty extended levels. But getting up to 75, 80%, that's a lot of the times what you also tend to see is just higher than 50 or 60%. That's kind of like a coin toss. That's a strong market, but that's not an overly strong market. As far as the AI investor sentiment survey, 45.5% of investors are bullish, neutral investors coming in at 27.3%, and bearish investors also at 27.3%. The 2 and 10-year yield curve inversion is almost inverted again from being positive over 22 basis points at one point just on September 25th. You're almost back to inverted, only positive 4 basis points now, and you've rapidly seen this go closer to inverting again, which is kind of crazy. And again, really this week is all going to be about oil markets with this presumed Israel retaliation against Iran coming in just the next couple of hours. I mean, take a listen to this clip posted to CNBC. It's only about 3 minutes long, but this guy is with Moody's and he says nothing does more damage to the economy than a spike in oil.
Right? Plus 62%, and Boeing workers, if I guess they're fortunate or lucky, they're going to get paid more as well. So that's going to push up wage costs and wage growth. And usually, the classical model is as wage growth goes up, right, it moves in inversely to where the stock market goes. Do you believe that model, and are you worried?
No, I'm not. I mean, wage growth is strong. But if you, particularly for these deals, 60% over 6 years, that, that's, do a little bit of arithmetic, that's a pretty significant pay increase. And, the auto workers, when they struck not too long ago, they got a pretty big increase. Of course, Boeing's still on strike. We'll see how that plays out. But that goes to the very tight labor market. But, if you look at wage growth across the economy, across all industries, occupations, everything, it's somewhere around 3.5% to 4%, which is just about where you'd want to see it, given underlying inflation and given, most importantly, productivity growth. The other thing that's going on, Martin, is U.S. productivity growth is extraordinary, and that allows businesses to continue to maintain their margins and corporate earnings, and that's obviously critical to the equity market, but at the same time pay their workers more. So hopefully these strong productivity gains continue going forward, because they're really allowing for strong wage growth, good earnings, and a high stock market.
Yeah, and we've whacked one inflation mole with the East Coast port strike, potentially, haven't we? But we've got the Middle East situation unfolding, and Middle East on a knife edge in terms of stability and disruption to oil supplies, potentially. How is that going to change the calculus in November for the Fed?
Yeah, this I worry about more. Nothing does more damage to the U.S. economy and much of the global economy than higher oil prices. It's a negative supply shock. It hurts growth because it reduces people's purchasing power, particularly lower middle income households. They have to put more of their hard-earned money into their gas tank. They have less to spend on everything else, and it causes higher inflation. So, puts the Federal Reserve and other central banks in a pretty difficult spot. What do? Do they respond to the weaker economy and growth by lowering rates, or do they respond to the higher inflation and don't cut rates or raise rates? So it's a very difficult problem. If all that we see here is what we're seeing, right now oil prices are up about $5-10 a barrel as a result of events. If that's the end of the story, I think we're okay. The Fed's going to continue on its path, no change. In fact, oil is now sitting somewhere in the mid 70s, whether it's Brent or WTI, and that's kind of consistent where it should be in the long run. But if prices go higher, if, for example, if, Iranian oil production is actually, infrastructure is actually damaged by whatever the
Yes.
Israelis do, and we get to 80 or 85 or 90, that's a different ballgame, and that's a real problem.
Now, the VIX is also something worth watching. It's sitting at 19.21, following all of this good data that we've gotten recently, following the prevailing soft landing narrative, and the VIX is still at 19.21. Why? Well, there's appetite for downside protection. People are still kind of fearful. Why? If I mean, almost everyone you hear on Wall Street sounds very bullish on this market, but yet their actions are doing something different, and the VIX is telling us that. And some other people on Wall Street are saying the VIX at 19.21, including someone like Tom Lee just said this last week, this could actually be a sign of more volatility to come, downside volatility that is, in October. Now, specifically for Tesla stock and the robo-taxi event, I do think earnings on Friday, they're going to be important for markets. I think that of order of magnitude is the most important thing for markets right now. Again, it's earnings at the top of most importance. It's economic data and the economy, and those kind of play into each other, right? If economic data weakens, earnings are likely going to weaken as well. I do think Q3 earnings season, this upcoming earnings season, is going to tell us more about the economy, about the consumer, and that's kind of why I put it ahead. But a lot of the times economic data goes and then earnings go. But I do think earnings are more important. And then you have your economic data, which again kind of feed into the two. Then you have this Middle East situation down here. I put that as third on the list because there's so many different outcomes. If this is just some kind of retaliation strike against Iran's military facilities, then we're fine. Markets are going to do just fine. If this is some kind of attack against Iran's military facilities and some of their oil capabilities or nuclear facilities potentially, that's where this becomes a front and center issue. Maybe in the near term, more important than Q3 earnings. If oil were to spike big, yeah, that's going to really affect the markets in a large way. And that's also going to affect Tesla stock. Now, Tesla has, again, the Robotaxi event upcoming this week. As long as we don't see that worst case scenario from the Israel retaliation against Iran here in the next couple of hours, I do think Tesla stock is going to go materially higher. I don't think the markets need to crash for this week, even though that's kind of historically what happens this week during an election year. I just don't think that is a foregone certainty or conclusion. So I do think in the next couple of hours, we will know more about how the rest of this week is going to play out. Let's face it, besides initial jobless claims, we have CPI. I don't think that's a big catalyst. We have PPI. I think that could be a little bit more important, but really, I mean, are markets going to respond too much to that? Probably not. Michigan consumer sentiment, that's really not a huge catalyst either. So we actually don't have much as far as important economic data right now because Wall Street just wants to know, how is the consumer doing? Are they slowing down more? How is the labor market? And, CPI, PPI, they're not going to tell us anything about the labor market. And as long as inflation's not going higher, then I think markets are just going to look past it. For that reason, though, I do think there's going to be a lot of volatility potentially with Tesla and markets this week, depending on what happens. That could be upside volatility or it could be downside volatility. We have sold off quite a bit in the last couple of weeks, 1 to 2 weeks or so in the S&P. It's been pretty volatile, generally have kind of trended downwards. Tesla stock over the last couple of days has also sold off. So potentially you could get a bounce back kind of rally if we do buy the attack from Iran. If the reaction of markets is, okay, it's over with, we didn't get the worst case scenario, which was an impact to the oil markets and or Iran's nuclear facilities, we can go ahead and buy markets now. Okay, that is potentially going to be an actual bullish event for this week. But again, we'll have to see. Depends on, what happens with the actual strike or not. And I would expect Tesla is going to react very strongly to an upside move in our markets, considering the Robotax event is this upcoming Thursday. If markets rally, Tesla stock's going to rally a lot more. If markets sell off, Tesla may actually hold up a little bit better because it did sell off a little bit more in the last couple of days, but that is to be determined. Let me know what you guys think about this information down below in the comment section. Hit the like button as well as subscribe to the channel if you have not done so already. You guys have a great rest of your day, and I will see you in the next one.